Let's dive right into one of the most exciting, controversial, and structurally important developments in the global commodities markets today, the silver market, and in particular, why silver prices in Shanghai are trading significantly higher than in Western markets, with premiums as large as $8 to $10 per ounce or more. Right now, the price of silver in Shanghai has exploded relative to Western trading benchmarks like COMEX, with spot silver prices in China trading at a 9 to 10% premium over international prices, and in some cases even higher depending on the data source. Just this week, spot silver in Shanghai was quoted about $8.71 per ounce above the comparable Western market price, a spread nearly 10%. To put this into perspective, this isn't a minor anomaly. Historically, prices between Shanghai and Western benchmarks have been tightly correlated, separated by only small differences due to short-term technical factors. But over recent months, that long-standing equilibrium has broken down dramatically. So why is this happening? What does it mean for the future of silver prices? And, crucially, what should traders, investors, and long-term holders understand about this divergence? To answer that, we first need to understand how the global silver market actually works, and how China's physical market differs from the Western paper-dominated markets. In the global commodities world, prices are often set through futures and derivatives trading. On Western exchanges like COMEX in New York, most silver is traded as paper contracts that represent a claim on silver rather than silver itself. These contracts are highly liquid and dominated by traders, hedgers, and institutional speculators. By contrast, Shanghai's silver market is heavily influenced by actual physical delivery and industrial demand. When Chinese buyers are looking for physical metal, for industries like solar panels, electronics, and manufacturing, they are willing to pay cash for metal that can be delivered immediately. That pushes the local spot price higher than the prices seen on paper exchanges. That difference is not just academic. It's been the core reason why Shanghai's silver is trading at a premium of around $8.70 to $10 per ounce above Western prices. In normal market conditions, arbitrageurs would move metal between markets to profit from any significant price difference. But in this case, arbitrage is not happening fast or effectively because your average physical bar of silver in Shanghai can't simply be shipped to New York to close a price gap. There are regulatory controls, capital flow restrictions, logistical friction, and time delays that make this difficult. That means the price link between Shanghai and the West has become much looser, and the markets can actually diverge for extended periods. What's driving the Shanghai premium? There are several key factors behind the premium. 1. Strong industrial demand in China. China is one of the world's largest consumers of physical silver, particularly for high-demand industrial applications like solar panel manufacturing, electronics, and heating systems. As demand in these sectors accelerates, buyers are literally paying more to secure metal immediately, rather than waiting for paper contracts to settle. Physical buyers in China have been paying up relative to global benchmarks because the market there is more supply constrained. And when supply is tight, cash buyers pay premiums to secure the metal they need now. 2. Physical supply constraints and inventory drawdowns. It's not just regional. COMEX inventories in Western vaults have been drawn down aggressively in recent months. Total registered silver holdings on COMEX have fallen below 100 million ounces, down significantly from previous levels, which suggests physical metal is leaving Western markets and ending up in private hands or other delivery channels. That depletion of deliverable Western inventories creates downward pressure on the ability of paper markets to reflect physical scarcity, even while real metal is being claimed and withdrawn. 3. Regulatory, logistical, and capital restrictions. Even when the price difference is large enough to justify arbitrage, physical silver cannot be easily moved across borders and exchanges to close the gap. Transportation costs, regulatory barriers, and export/import controls slow down or block the natural arbitrage mechanism. As a result, Shanghai can trade at a premium for an extended period because the physical metal simply doesn't flow quickly between West and East. 4. Structural supply versus demand fundamentals. It's also important to remember that silver supply has not kept pace with demand globally. Limited new mine production, rising industrial use, and growing investment demand have underpinned prices. Meanwhile, physical markets, particularly in Asia, are pulling more metal into delivery rather than paper positions, which further tightens physical availability. All of these dynamics reflect a market where physical demand is starting to dictate pricing more than paper titles or futures contracts. That's a structural shift, not a short-term technical blip. So, we've laid the groundwork for why silver in Shanghai can trade at a premium of roughly $8 to $10 per ounce above Western spot prices right now, and we've begun to unpack the interplay between physical scarcity, local industrial demand, and global inventory dynamics. Now that we understand why silver in Shanghai is trading at a premium of roughly $8 to $10 above Western prices, the next question becomes even more important. What does this divergence signal about the underlying health of the global silver market? Because here's the critical point. Price divergence is not random. It is information. It is a signal. And in commodities markets, signals like this often appear before major structural moves. When we look at Western pricing benchmarks, particularly futures trading on the commodity exchange in New York, known as COMEX, we are looking at a market dominated by leveraged contracts. The majority of trading volume does not represent physical delivery. It represents financial positioning. Traders speculate on direction, institutions hedge exposure, funds rotate in and out based on macro data, dollar strength, bond yields, and Federal Reserve expectations. In contrast, pricing on the Shanghai Gold Exchange reflects a much heavier weighting toward physical settlement. Buyers are not simply betting on price direction, they are securing actual metal. That difference matters more than most investors realize. If Shanghai silver is trading near the equivalent of $100 per ounce, while Western futures hover closer to the mid-80s, the spread is not just about currency conversion or short-term volatility. It suggests that physical metal in Asia is commanding a premium because buyers need it now. This is where the conversation becomes serious. Historically, when regional physical markets disconnect from Western paper benchmarks, one of two things eventually happens. Either the premium collapses because demand slows and supply normalizes, or Western prices rise to catch up with physical reality. Right now, Western markets appear stalled. Futures have struggled to sustain rallies above the mid-$80 zone. Profit-taking, algorithmic trading, and macro headwinds have capped upside momentum. Stronger U.S. dollar movements in recent sessions have also pressured commodities broadly. When the dollar strengthens, silver often experiences short-term selling pressure. But here is the contradiction. At the same time, Western futures stall, physical demand indicators in Asia remain firm. Industrial buyers in China continue to accumulate metal for solar panel production and electronics manufacturing. Silver remains a critical input for photovoltaic cells, and China continues to dominate global solar manufacturing output. That structural demand is not speculative, it is industrial. If industrial buyers are willing to pay a premium, that tells us something about tightness in the supply chain. Now let us talk about inventories, because inventories often reveal what price charts hide. Registered silver inventories in Western vault systems tied to COMEX have trended lower compared to prior peaks seen in earlier years. While total stocks fluctuate week to week, the broader pattern shows metal moving out of registered categories and into private or eligible categories. In practical terms, that means less silver is readily available for delivery against futures contracts. If physical delivery demand rises while available, registered inventory falls, pressure builds beneath the surface. Think of it like a dam holding back water. The paper market can absorb selling pressure for a long time. It can suppress volatility. It can create the appearance of balance. But if enough physical metal is pulled from the system, eventually the structure becomes strained. This is why many analysts are watching the Shanghai premium closely. It may not immediately push Western prices higher, but it represents tension in the system. There is another angle to consider: arbitrage. In theory, if silver is $10 more expensive in Shanghai than in New York, traders should buy silver in the West and ship it east for profit. That action would close the price gap quickly, but in reality, arbitrage is not frictionless. Cross-border capital controls, shipping delays, regulatory procedures, purity specifications, and exchange rules all slow the process. In addition, not all silver contracts are interchangeable across exchanges without specific certifications and approvals. These frictions allow the premium to persist longer than textbook economics would suggest. Now let us ask the most important forward-looking question. What happens next? There are three primary scenarios. First scenario, the Shanghai premium collapses.